I think it is, I truly believe it is not being value investors. No, admittedly, it's difficult not to pay attention to, everybody has a Bloomberg machine or something, not to pay attention to, daily changes in stock prices. In a way, if instead of investing in securities, I invested in buildings, in real estate, if you're an investor in real estate, if you own a few buildings, or if you own even one building, you don't worry about the price of your building on a daily basis because there is no daily transaction. It's less difficult to be a long-term owner if you own real estate or in general illiquid assets than it is with equities that trade daily. Right. So I think the biggest mistake is to pay. It's not for nothing that Buffett is one of the richest men in the world. It's because he has a very sound approach to investing. Now, it's not a recipe, it's not a formula. Of course, his enormous success is due to a large extent to his own extraordinary skills. But, when he wrote that article in 1984, it was in an attempt, which was a humble attempt in a way, to say that his own success, which was already obvious in the mid-80s, was due not just to his own skills, but also due to how sound his investment approach was. And I think most investors, including professional investors, have an investment approach, and maybe they cannot avoid it because there is, what Jeremy Grantham called a career risk, which is not, nothing to be ashamed of. So the mistake they make is to pay too much attention to the short term. Ben Graham was right. Short term, it's a voting machine. So you're in the hands of market psychology if you invest in the short term. If you invest in the long term, it's a weighing machine that weighs the realities of the business. It's like, the Frenchman who told me, hey, if we, the French, we don't buy that small stock which you own, it will never go up. Well, no, it's not true. It may go up after a long period of time, but it will go up if it deserves to go up.